Hello students, welcome to our third lesson. This is business studies, topic international trade, which will be our very last topic. Yesterday we did look at certain aspects of business studies, especially international trade, and we gave an assignment on some of the circumstances or reasons that could lead to unfavorable terms of trade. Today, I want us to look at, or in this lesson, I want us to look at the reasons for differences in the terms of trade between countries. We realized in our previous lesson that the term of trade refers to the rate at which a country's exports exchange with their imports. And we did say that terms of trade is equal to the export price index over the import price index times 100%. Now, some of the reasons for differences in the terms of trade between countries, number one, is the nature of the commodity being exported. A country that exports raw materials or unprocessed agricultural products will experience unfavorable terms of trade compared to that country that exports manufactured goods. And this is because most of the manufactured goods or most of the processed commodities fetch higher market prices compared to unprocessed or raw agricultural products. Another reason for this difference is the nature of the commodity being imported. A country that imports manufactured products will definitely have unfavorable terms of trade because they will spend more money in importing than what they will get from their agricultural produce. So a country that imports processed materials will experience unfavorable terms of trade compared to that country which imports raw materials. Another one is the change in demand for a country's exports. An increase in demand for a country's export at the world market will make it have favorable terms of trade as compared to those with low demand at the world market. Another reason is the existing world economic order, which in most cases will favor products from more developed countries. And this will make the developing countries to have deteriorating terms of trade, resulting to unfavorable terms of trade. Another reason is the trade restrictions by trading partners. And another one is the total quantity supply. A country exporting what most countries are exporting will have their products trading at a lower price, hence experiencing unfavorable TOT. Now that brings us to the end of the terms of trade. Another closer term to the terms of trade is the balance of trade. And what is the balance of trade? Balance of trade refers to the difference between the value of visible exports and the value of visible imports over a given period of time. Our emphasis in this case is visible exports and visible imports. And what are visible exports and imports? Visible exports and imports refer to tangible goods such as vehicles, coffee, tea, and anything that can be touched. Balance of trade or BOT can also be favorable, unfavorable, or can be at equilibrium. The BOT can be favorable when the value of visible exports exceed the value of visible imports. It can be unfavorable when imports exceed exports, and that is visible and invisible. And it can be at equilibrium when the value of visible imports is equal to the value of visible exports. Now, when trade takes place, both the visible and the invisible, there is a need that as we trade in the visible products, we also trade in the invisible products. Now, balance of trade deals with the visible exports and the visible imports. What of the balance of payments? The balance of payments now deals with both the visible and the invisible products. As the balance of trade deals with the visible only, the balance of payments now deal with both the visible and the invisible products. Just like in other cases, it can also be favorable, it can be unfavorable, or it can be at equilibrium. And now you know when it can be favorable, when both the invisible and visible exports are more than the visible and invisible imports, and so on for the unfavorable, and even at the equilibrium when all of them are equal. Now, just like in home trade, there are transactions that take place. When countries do businesses, there are certain transactions. There is exchange of goods and services for money. And there is need that these records are kept. Now, the balance of payments deal with certain accounts where transactions are recorded. And these accounts are generally referred to as the balance of payments accounts. The balance of payment account can be defined as a summary showing all the transactions that take place between a particular country and the rest of the world over a given period of time. These transactions that are recorded arise from these three items: trade in tangible commodities or visible goods, trade in invisible goods, also known as the services, and the flow of capital into and out of the country. And we will look at what they mean as we move forward. In our next lesson, we are going to look at the components of the balance of payments account. Thank you.